Are you new to the home buying process and considering buying a home towards the end of 2020 or maybe into 2021, but not sure where to start? Well, in today's video, I'm going to guide you through the process of getting a home loan, where to start, who to talk to, the requirements that are needed in order to get that process started. My name is Jeb Smith. I'm a real estate broker here in Southern California, and typically I don't have this thing on my face, so I apologize to all of you who are watching. Think I look like a creep. I agree with you, but unfortunately it's in today's video, so you're gonna have to bear with me, but that's not what the video is about. The video is about helping guide you through the process of buying a house. And these questions that I'm going to talk about today often come up when I put videos out on the home buying process. So I'm gonna answer questions like, where do you apply for a loan? Who do you talk to? What requirements are necessary? What kind of credit score do you need? What kind of income do you need? What else is taken into account when applying for a home loan? And if you're interested, I'll link to a couple of different videos throughout this video with regards to FHA requirements and different requirements when buying a home. But let's start today's conversation by talking about where to go to initially start that conversation. This is probably the most often question I get, and it's one that's often overlooked because you just assume that everyone knows where to go to talk to a mortgage professional. Well, I guess not. So I want to start today's conversation by talking about where do you apply. There's a couple of different places to start. One, and probably the most common, is your bank. Most banks out there, your bigger banks, your Bank of Americas, your Chases, your Wells Fargos, depending on where you are in the country, maybe a different branch, but you can go into your local bank and typically apply for a loan. There's usually someone there that can guide you through that process. The downside to using your mortgage bank, your bank to get a mortgage is that, their box is pretty small with regards to the options that they have for buyers. If you fit into that box, then typically they have really great options for you. But if you don't fit into that box, they might not be able to provide you with the best terms. In some cases, they might not be able to provide you with a loan at all. Your next step would be talking to a mortgage broker. What is a broker? A broker is someone who has access to multiple programs, different banks that offer different programs. So we categorize the bank as having a small box. The broker would have a very large box because they can send your loan to multiple lenders depending on the type of loan that you're trying to do. This benefits you in multiple ways. One way is that they have access to more programs. So if you don't fit into box A, maybe you can fit into box B or C, which may have different lending guidelines in order to help you get qualified. They also may have different credit requirements. Some banks have very strict credit requirements. Others are a little bit more lenient on the credit, and going with a mortgage broker will allow them to shop that for you. The next thing would be talking to a mortgage broker. They can shop interest rate. Typically, when you go into your bank, they just have their programs that they offer. A mortgage broker can shop around to different banks to find out who has the best interest rate and provide you with different options with regards to rates when applying for a home loan. So that is how you initially start the process. Now, if you don't have a mortgage broker in your area that you're familiar with, maybe ask a friend or family, someone who has done a loan recently, and perhaps they can guide you in the right direction. If you're watching this from anywhere in the United States and you need a referral to a mortgage broker, reach out to me directly. I get nothing out of this other than making sure you're taken care of. There's no compensation to me when making the referral, but I'm happy to put you in touch with someone who can guide you in the right direction. So do me a favor, if you have questions, reach out to me directly. I'm happy to put you in touch with a mortgage broker in your area who can help you with the loan process. Now that you know where to start in applying for the loan, let's talk about some of the requirements that are needed in order to actually get a loan. There's 4 different things that most lenders are going to want to see or go over when applying for a loan. Those are going to be credit score. Your credit is a very important piece of the puzzle. And keep in mind, if you have lower credit scores, that does not necessarily mean that you can't qualify for a loan. FHA allows credit scores as low as 500, whereas conventional loans, typically they don't want to see credit scores lower than a 620. So depending on how your credit score is rated may depend on the type of loan program that you go with, but credit is definitely an important piece of the puzzle. Next is going to be job history. Most lenders need to see at least 2 years of job history of employment, consecutive years typically with not necessarily the same company, but in the same line of work. So if you've been a server for 2 years, typically you've got to be, in that restaurant business, that line of work for at least 2 years. You can't have, say, been an artist and then been a server and then been a mortgage professional and then been something else, because lenders want to see that you have some consistency in your employment as well as the income that's associated with it. And that's going to be the next thing. Income is going to be another piece of the puzzle outside of job history. They want to see some consistency in the income. And lastly is going to be assets. They need to see down payment. They need to see some money in the bank if you're planning on buying a home, regardless of whether the money is coming from a parent, a friend as a gift, or if it's coming out of your bank account. Lenders typically want to see at least 2 months bank statements, whether it's a checking account, a savings account, a 401k, an IRA, stocks, whatever it is. They want to see what you have to work with. Now, this is a conversation when you can have when you talk to your lender. Some lenders are more strict in what they require, while others may not need to see a lot of money in the bank. But that is typically something that's going to come up when you're having that conversation. So what I would do is, if I was thinking about applying for a loan, I would start gathering those documents. I would get my W-2s, I would get my tax returns ready. I would also get my bank statements, checking accounts ready. And and then you have the necessary documentation that is needed when talking to your lender, because that's going to be one of the first things that they ask for. You're going to have to fill out a loan application with that lender, and this process shouldn't cost you any money. It should be a free process, even though it costs the lender a little bit of money to run your credit score. But you're going to have to fill out a loan application. You're going to have to provide them with your social security number and those documents that I mentioned a moment ago, which are your tax returns, your W-2s, your bank statements. And then from there, what they do is they take those documents and they look, they run them. What do they mean by run them? They analyze your income. Lenders are going to use your gross monthly income. That is not the amount you take home, that's the net, the total monthly income. So before any taxes are taken out, that is the amount of money that the lender is going to use to qualify you for the loan. And typically, depending on what type of loan you do, whether it's conventional and or FHA, the debt to income ratio is going to be somewhere around that 45 to 50%. What does that actually mean? Well, they don't want to see you spending more than 45% or so on a conventional loan and around 50 to 55% of your income on an FHA loan towards debt. That includes your mortgage payment, your taxes, your insurance, any car payments, student loans, credit cards. All of that is part of that process. And that's why it's really important to actually go through the pre-approval process with a lender prior to going to shop for homes, because you want to make sure that you're fully pre-approved before you go out there and fall in love with a property. And talking to a lender up front will allow you to go through that process, allow them to look at your credit report, look at your tax returns, and tell you exactly how much money you can qualify for when buying a property. Now, if you're interested in FHA, what I'll do is I'll link to a video here that goes over specific FHA requirements, because FHA loans are a little bit different than conventional loans. They do allow lower credit scores, lower down payments, but they're stricter in other areas. So take a look at that. And then also, if you're thinking about putting an offer in on a home but are not really familiar with that process either, I'm going to link to another video here that talks about the process of buying a home in this market and exactly what you need to do to set yourself up for success when going through that process. But I encourage you, if you are watching this video and you have questions, do me a favor, leave them below. And if you have something you want me to touch on that I didn't hear, I also encourage you to leave it below. And if you're still watching, do me a favor, hit that subscribe button. And if you like content like this that helps guide you through the real estate process and answer your questions, hit that subscribe button, because I'm always up and keeping you educated on everything with regards to real estate. So for now, I appreciate you taking the time to watch. I appreciate your support, and I hope to see you again soon. Have an awesome day. Bye-bye.